Hello everybody, Jumma Mubarak to all my viewers. After a long time, I thought of coming up with one video on consolidated profit and loss account, specifically dealing with unrealized profits, fair value adjustments, and other small adjustments that could come at medium level. It's not the top most complicated topics I'm going to discuss today. I'm just going to talk about certain implications and adjustments that could have an impact on producing a consolidated profit and loss account. So I'm going to pick one example. That example is here. This example is actually a question picked from BPP material. The statement of profit and loss and other comprehensive income of P company and its subsidiary S company for the year ended 31 December 2014 are as follows. And they have given you the income statement, and then they are kept on giving certain additional information. On 1 April 2014, P company purchased 80% holding of S company for 13.8 million in cash. S company total comprehensive income for the year ended 31 December 2014 was 2 million, accruing evenly over the year. S company did not pay any dividends in the year. P company paid dividends of 3 million in the year. At the date of acquisition, the fair value of S company's assets were equal to their carrying amount, with the exception of the items listed below, which exceeded their carrying amounts as follows. Inventories 300, plant and equipment 10-year remaining useful life 1200. S company has not adjusted the carrying amounts as a result of the fair value exercise. The inventories were sold by S company before the year end. The NCI in S company to be valued at fair value of 3.2 million at the date of acquisition. An impairment is conducted at the year end revealed that the consolidated goodwill of S company was impaired by 150,000. On 1 October 2014, S company sold goods to P company for 200,000 at a gross profit. S company, meaning subsidiary, sold goods to parent company at a gross profit of 40%. The goods were still in P company, meaning entire goods were still in P company's inventories at the year end. No other sales were made between P company and S company. At 31 December, P company's current account with S company was 130,000 credit. This did not agree with the equivalent balance in the S company's books due to cash in transit of 70,000, which was not received by S company until after the year end. Prepare the consolidated statement of profit or loss and other comprehensive income for the P company group for the year ended 31 December 2014. Now here please note, the question is to deal with consolidated profit and loss account. So we may not necessarily to perform workings relating to consolidated statement of financial position. If the examiner is asking you a comprehensive, complete financial statement, then we may have to perform other workings also. But here we will only take relevant workings, that is to consolidated profit and loss account. So to start with, so what we do is we perform the group structure. The group structure shown here, if you closely watch, P company acquiring S company, then acquisition date is on the 1st of April 2014, meaning the acquisition took place during the period. So investment is 13.8 million. If you see this diagram here, so this is the 1st of January and this is 31st December, and the acquisition took place on this date. So there is 3 months period here. This 3 month period we call it pre-acquisition. And the 9 months period here, this 9 months period we name it post acquisition. And the examiner given you the total profits for the year is 2 million. And then is that what they say? Can I read it again? The total comprehensive income is 2 million. this we need to separate or split as to pre-acquisition period and post-acquisition period. You can understand that the pre-acquisition period is 3 months, so 2 million into 3 over. The examiner also told you that the profits are accruing evenly over the year, meaning every month equal profits. So accordingly, 2 into 3 over 12, which is 500, and 2 into 9 over 12, which is 1500. You have to take it accordingly. And then now what you need to do is that we also need to factor about other additional information. So they gave you here that at the date of acquisition, the fair value of ex-company's assets were equal to their carrying amounts, with the exception of the items listed below, which expected total carrying amounts were as follows. At the date of acquisition, now here what we need to do is we need to have something called a fair value movement. So this one. So at the date of acquisition, my fair value of the property, plant and equipment exceeded by 1200, inventory is exceeded by 300. And the examiner was saying that the inventory was fully consumed or sold before the date of balance sheet. So at the date of balance sheet, there is nothing left for inventory. However, the property, plant and equipment, the remaining useful life is 10 years. So what you do is 1200 into 1 over 10 into the period that we are working on is 9 months. So my additional depreciation comes to 90. So accordingly, I worked out that. And further, we also have unrealized profits. The unrealized profits, what they are talking about unrealized profit here, this one. The subsidiary selling goods to parent, 200,000. The 40% is the margin, and the full amount is still remaining with the warehouse of the parent. So therefore 200,000 into 40%, I am getting an unrealized profit of 80, which I need to adjust. Furthermore, there is goodwill impairment. The goodwill impairment of 150, that also needed to be adjusted. Now we move on to the consolidated profit and loss account. So I have the sales. If I look into the question, my sales here 28,500 and 11,800. 28,500 is fine. From 11,800, what you do is you need to time proportion in order to get 9 months working. So 11,800 into 9 over 12, I'm getting 8,850. So that is this. And since we have intercompany or intercompany sales of 200, which I need to eliminate. So my consolidated sales 37,150 and consolidated cost of sales 17,100. And again, please note that I need to time proportion this as well. My cost of sales 7,000. That 7,000 I need to work it out for 9 months. So you get 5,250. So 17,100, 5,250, and then you adjust the cost of sales, the intercompany cost of sales, and then your cost of sales comes to 22,150, and you have unrealized profit 80. We have worked out, and fair value movement 390. We understand now here. What is that? Let us look into that here. See what happens. Yeah, yes. So this is the movement column. During the total movement is 390. This should be taken to income statement as an expense. So which I have taken here, and accordingly I am arriving my gross profit 11,400, 3,600, and then the net answer here is 470. So 14,530. And then I have expenses 4,400 from the parent company. And then 2,200. Of 2,200, here again 9 months working, you need to arrive this answer. And this 150 is the impairment of goodwill. So total expense comes to 6,200, and then I have profit before interest and tax 7,000, 1,950, and the total adjustment or workings 620. Accordingly, my profit before interest and tax 8,030. And finance cost, you have been given finance cost here 400 and 200. What you do is you take full 400 for parent, but for 200 you need to take only 9 over 12. which is 150. So total 550. Then you get profit before tax 6,600, 1,800, and the 620 continues. So the net answer for consolidated profit before tax will be 7,780, and the tax again the same story, 2,100 and 800. 2,100 you take it. This 800, what you need to do is 9 over 12, you get 600. So 2,700. So profit for the year you are getting it. And then the question also giving you property valuation for other comprehensive income. So 900 for parent and 400 for subsidiary. So 900, 100% I take from 400. Same story, 9 over 12, you get 300. So you get total other comprehensive income is 1,200. Accordingly, this we name it total comprehensive income. One last step, I need to split this 5,080 and this 6,280 as to attributable to parent and subsidiary. From 5,080, I need to figure it out how much is the non-controlling interest. For that, we should have a working. What we do is we take the subsidiaries profits and subsidiaries total comprehensive income as to how much, 1,200 and 1,500. From where I got this? I get that from here. You see, 1,200 and 1,500. So I start with that, and then I take all the applicable adjustments. Impairment 154, which is applicable to both. Fair value movement 390 applicable to both, and unrealized profit 80 applicable to both. So net answer is 580 after all these adjustments, 880. Applicable NCI is 20%. So accordingly 116 and 176. What you do then? You subtract 116 for the profits. So your parent attributable to parent is 4,964, and then 176 you subtract, and accordingly attributable to parent is 6,104. And this would provide clarity as to how you approach consolidated profit and loss account. Thank you so much for watching. Keep on tuning on to my YouTube channel and subscribe to my channel so that if you have any question or doubts, please do contact me. My phone number is 5000 8194 Qatar code. Thank you.